So now we're going to talk about the decisions that farmers make during the marketing year in order to market their crop. Largely, we're going to focus on the decisions that farmers make when they're pricing their crop, but we're also going to talk about the decisions that farmers make with respect to crop insurance, because crop insurance is now one of the marketing decisions that farmers make. When it comes to pricing the crop, one of the questions you might ask is what drives that pricing decision? And there's a couple different criteria that farmers might use. One of the most common criteria is a timing-based decision where farmers spread out the sales during the time of the year and decide that they're going to price a portion of their crop during a specific time of the year. We're going to go through an example in more detail on these timing-based decisions. Another criteria might be outlook, and by outlook we mean what do we expect to happen to futures prices and basis in the coming 12 months or 2 years, and using that forecast of where prices are going to go to decide when to price the crop. Another criteria is the cost of production threshold, and this would be one that farmers would use when they've established the cost of their inputs and then they know the break-even price that they need to receive for their crop in order to make a profit. Once they know that break-even price, they can use that as a benchmark to decide what is a good price offered by the market, when are they locking in a positive profit margin. Another criteria is cash flow needs, so that as bills come in and farmers need to raise cash to pay their bills, that they would then take the grain to the market, sell it to the elevator, receive the cash, and use it to pay off those bills. The last criteria is emotion, and this is one that's not generally recommended, but this is certainly one that farmers face, that anybody who invests in futures or even our retirement portfolios might be subject to emotion, where you might get excited and about the prices in the market and wait to price a little bit too long, and then as prices come down you get a little bit depressed, and then you decide you're going to price when the prices are down rather than what would be optimal from a less emotional perspective, which is that seeing high prices, saying, wow, that's a really high price, it's giving me a really high positive profit margin well above my cost of production threshold, that's the time I need to price. Okay, so before we talk about when you make these decisions, we've got to introduce the concept of the marketing year. Now, the marketing year is defined by the USDA as the accounting period for a crop year. For corn and for soybeans, that marketing year starts on September 1 and goes through August 30th. For wheat, the marketing year is from June 1 to May 30th. The choice of when the marketing year starts and ends is largely about the timing of the harvest for that crop. For corn and for soybeans, the harvest in the Corn Belt really starts in September and really heats up in late October, whereas for wheat, the wheat harvest really starts rolling in July. So the accounting period that the USDA uses in terms of the marketing year is all based around when the harvest occurs. So what is our current marketing year? For corn, our current marketing year is started on September 1 of 2011 and it's going to go through August 30th of 2012. One important point to make is from the farmer's perspective, the crop that they planted and that's going to be marketed during the 2011-2012 marketing year was planted in the spring of 2011 before the marketing year started. Alright, so now let's look at the 2011 timeline for marketing decisions. Now, when farmers are thinking about marketing their crop, they start thinking about marketing that crop before they even plant it sometimes. So a typical marketing window for a crop, or for the crop that is harvested in the fall of 2011, might start as early or even earlier than January of 2011. So for this crop, you would plant it in the spring of 2011, harvest it in the fall of 2011, and then market it all the way through the winter and spring of 2012. Now, we can think of the marketing period is broken up into 3 major windows. There's the pre-harvest pricing window, and this is the pricing window through about October of 2011, when the farmers and the grain buyers have no idea what the yields are going to be. So from the farmer's perspective, they have no idea what their yields are going to be. They have no idea how many bushels they're going to have to sell. From the buyer's perspective, because it's before harvest and they don't know what the production is going to be, there's a lot of basis uncertainty for them. So they tend to bid a very wide basis or a very weak basis in order to push that basis risk onto the farmer. So farmers that want to price their crop in terms of a cash forward contract or any contract that establishes the basis during this pre-harvest window would tend to face a very weak or wide basis. So maybe in central Indiana, if you would normally expect a 25 under basis for corn at harvest, during this pre-harvest pricing window, the buyers might be bidding a 40 under basis. You jump forward, and the next window we consider is that harvest window. During harvest, farmers are learning what their yields are actually going to be. Grain buyers are also learning how much production there is in their area. During this time period, because there is a lot of availability of grain, there are a lot of farmers out there that simply don't have any storage, or they don't have enough storage to store their full crop. These farmers are then going to be forced to bring their corn to the elevator to sell it during this harvest period. Because of this, the grain elevators and the grain buyers in general know that they're going to be receiving grain simply because of harvest logistics, and therefore they tend to bid the lowest cash prices or the lowest basis during this harvest window. The last time period is the post-harvest pricing window, and this is one in which the farmers and all of the buyers know what the production is in that time period. During this time period, the basis tends to appreciate. We tend to see the weakest basis at harvest when the buyers know that the farmers are going to have to bring them the grain. Once harvest is over and the grain is in the farmers' bins, you tend to see the basis appreciate because the buyers are going to have to pay a stronger basis in order to convince the farmers to load up the semi and bring the grain to them. So we tend to see a basis appreciation through that post-harvest pricing window, and what this does is it provides a positive return to storage for the farmer. All right, so now let's talk about that basic diversified timing pricing decision. The most basic example here would be one in which the farmer might divide this pricing window into 4 or more periods. And then they would price an equal percentage of the crop during each of these periods. In reality, most farmers are going to allow themselves some adjustment factor to price slightly more or less in each period, depending on whether the prices are favorable. So, for example, we see on the next slide the 2011 pricing window divided into 4 periods. Now, recall in that pre-harvest pricing window, farmers don't know what their yields are going to be. So at this point, the percentage of the crop that they're going to be pricing is relative to their expected yield. So, for example, you might have in central Indiana farmer that's expecting 180 bushels to the acre of their yield. So they would take that 180 bushels to the acre, and they're going to price roughly a quarter of their crop. Maybe 20% if prices are not that favorable, maybe 30% if prices are very favorable of that expected yield. You jump forward to the harvest window. This is the point at which they know what their actual yields are. They may at this point learn that they've got 190 bushels to price, and so they would now adjust what their percentage of the crop would be, or the number of bushels that they would price relative to what their yields actually are. And again, they would price maybe 25, maybe ranging from 20 to 25% of their actual yields in order to continue pricing the crop. You jump forward into the post-harvest pricing window, and they would divide it into 2 periods, maybe that early January to March time period, and then March into early summer, each of them pricing an equal amount of their yields that are available. So this is an example of a diversified pricing strategy where farmers are targeting pricing an equal portion of their crop at different points in the year. What this strategy does is it recognizes that it's very difficult to time when the highest price is going to be offered by the market, and by spreading out when the crop is priced, they do a better job of capturing an average price for the marketing year. You can think about this from a personal investment strategy or from a retirement portfolio as dollar cost averaging. Now let's shift and talk about how you might use Outlook in order to guide your pricing decisions. So for a farmer, if they think that the futures prices are going to move up and they think the basis in their area is going to get better, this is a case in which they're expecting their cash price to improve. If you're expecting the price to go up, then the optimal decision is to do no pricing today, wait for the price improvement to occur, and then to wait and price later. If, in contrast, they think the futures prices are going to move down, maybe because they think that while the market had been anticipating that China was going to buy a lot of corn, maybe China's no longer going to be buying a lot of corn, so futures would move down. But in their area, maybe they think the corn availability is short, so the basis is going to get stronger. In this case, what they want to do is lock in the futures portion of their cash price before those prices fall and leave the basis unpriced to wait till it improves at some later date. In order to price the futures portion of the crop but leave the basis open, they can either hedge with futures through their broker or use that hedge to arrive contract at the elevator that we talked about earlier. If they were using option strategies, they would buy a put option. Now, if a farmer believes that their basis in their area is going to get worse, maybe they realize that their neighbor had a huge, massive crop so that there's going to be more than ample supply in their local area, or maybe they know that a hog operation or one of the livestock buyers is going out of business so that the basis would be expected to get worse, they're going to have a different set of pricing decisions. Now, when the basis is expected to get worse, maybe the futures are expected to get up, what they want to do is lock in the basis portion of their price and leave the futures open to gain in value. The standard way in which to lock in the basis would be to use a basis contract, or they could use a strategy where they sold cash price or established the cash price and then bought a futures contract. In the last scenario in which they're expecting the futures prices to go down and the basis to get worse, the optimal decision is to price the crop now before your cash price goes lower. All right, now one of the things I want to talk about is how difficult it is to make these pricing decisions when you don't know which direction prices are going to go. Now, this is a picture of the December 2011 corn futures contract. So this is that new crop futures contract for the crop that's going to be harvested in the fall of 2011. And this is where those prices have traded going back to May of 2010. So one of the things that you can see on this chart just straight off the bat is there has been very, very strong upward price appreciation in the value of the December 2011 corn futures contract. Going back to May of 2010, December 2011 corn futures were trading in that $4 range, and then you jump forward to where we are today in this early September time period of 2011, and the December corn futures contract is now trading above $6. It had peaked right around August 30th, right at about $7.70. It slid in the most recent weeks simply because of the unrest in Europe and concerns about the U.S. economy and other economies around the world, just sort of general global economic uncertainty. But one of the things you can see is that any farmer making a marketing decision in this environment would have been in one where, if I add the additional piece of information that the cost of production numbers from Purdue would have said that the cost of production for this 2011 crop was somewhere around $4.25 a bushel. So any farmer making marketing decisions and pricing decisions, especially starting in that January 2011 time period, would have been making decisions in a pretty favorable environment. You know that the market is offering you prices that are substantially above your cost of production, and if you wait, the prices keep going higher. Granted, there were a few blips. You had time periods like when the tsunami hit Japan and the futures lost some value, and you had some uncertainty right after the actual plantings report on June 30th that also lowered the price in the market. But in general, this is a pretty easy marketing environment in which to make decisions because the prices keep going up and they're always, or for most of the marketing or most of that pricing window, the prices are well above the farmer's cost of production. Now, I want to contrast this with the 2009 marketing year where it was a very different pricing environment for farmers. Again, in 2009, farmers faced cost of production somewhere around $4 a bushel. And we think it's somewhere around $4 a bushel. It varied a lot from one farmer to another, but if you recall for that 2009 crop, that crop was produced with fertilizer that was quoted at times at $1,200 a ton. So in a world of very expensive fertilizer, you've got very high cost of production for this crop. The other thing you note, this is the December 2009 corn futures contract, so this crop would have been harvested in that October-November timeframe of 2009, and at that timeframe you had futures prices trading at a little bit below $4. You jump back to before the planting time period even, to September of 2008, early in the chart. That was when the global economy was starting to implode, but if you look back to that, we had set records on December 2009 corn futures in that $7 range earlier in the summer. And so you can see that in the late summer of 2008, the December 2009 corn futures contract was trading as high as $6.50. With the in September 2008, October 2008, we saw the December 2009 corn futures contract slide with the implosion of the global financial sector and the start of the U.S. recession that went through 2009, where December 2009 corn futures contracts just continued to decline in value. So this is an environment in which farmers have cost of production around $4, and let's just use that as a benchmark. And by and large, the prices that they were being offered by the market, they could have locked in some favorable prices in that pre-harvest time period, especially during the planting time period of March through May. But coming into the harvest time period, the prices they were being offered by the market were below their cost of production. Now, this is an example of a very tough time period in which to be marketing corn. The prices that you're being offered by the market, it's very hard to judge what's a good price or not a good price, because every price you're being offered is below your cost of production. Now I want to talk a bit about yield risk and pricing during that pre-harvest pricing time period. One of the things we saw on that December 2009 corn futures contract was there were opportunities to get prices above the cost of production during the planting time period of March, April, May. So during that pre-harvest pricing time period, the market will sometimes, and actually about 75% of the time, will offer the highest prices for the crop. Now, that said, there is a pretty big risk of pricing a large volume during that pre-harvest pricing period before you know what your yields are. This is because when farmers price the grain or write that contract for an elevator, for a cash forward contract, a basis contract, any of those contracts, they are committed to deliver those bushels. So that even if their crop were to fail, they still must deliver those bushels, even if it means that they have to go and purchase them from another farmer at the much higher prices that would be available at fall if there was a crop failure, and then deliver on that contract. So typically we have some pre-harvest pricing volumes that are recommended. We generally say that the first 25% of expected yields can be priced with a cash forward contract, generally without any concern about ultimate yields. With almost 100% certainty, you're going to at least produce 25% of your expected yields. If farmers want to price more than 25% of their expected yields, maybe up to 50%, we recommend that they wait until the summer, once they've gotten through the planting time period and know that planting has gone well, and perhaps even gotten through pollination and know that the pollination has gone well. So once they're a little bit more confident they're going to have good yields, they can go ahead and price another 25 to 50% of their crop. Or we recommend that they use options. One of the advantages of using options is there's no commitment of delivering the bushels linked to the options. So options eliminate the yield risk. Lastly, if farmers are thinking about pricing more than 50% of expected yields, we recommend very strongly that they have crop insurance at the highest possible coverage levels. That would be 85% or higher of yield or revenue insurance. All right, so that's a great transition into the crop insurance decision. Now, farmers make that crop insurance decision, and that deadline is the March 15th prior to planting. Now, there's 3 decisions they need to make, which is what type of crop insurance they're going to purchase, what coverage level they want, and what price they want for their crop. Now let's talk about crop insurance. Now, there's 2 broad types of crop insurance. There's the yield insurance and there's revenue insurance. Within the yield insurance category, there's 2 different types. There's the APH, or actual production history yield insurance, which is individual farm level yield insurance. And then there's the group risk plan, which is a county-based yield insurance. The way the APH yield insurance works is that farmers establish their actual production history, which is a minimum of 4 years of yield history and up to 10 years of yield history. If in any given year they have a yield that falls below their APH yield by a certain coverage level, then they would get a crop insurance payout. For the group risk plan, which is a county-based crop insurance, they're going to get a payout on that crop insurance if the actual county yield in a given year falls below the historical county yield that would be expected. Now, with the county-based crop insurance, a farmer could get a crop insurance payout because the county yield on average fell below what it needed to be, but they could get it in a year when they had a great yield on their individual farm. By contrast, a farmer could have a terrible yield on their farm in a given year, but if the rest of the county does well, the county actual yields may not trigger any crop insurance payment with the county-based program, and so at the end of the day, these county-based yield insurances don't work that well to protect farmers for their individual yield risk, and we only recommend that those farmers who have their farm yields that track the county yield really well would use these crop insurance programs. In the last couple of years, the Risk Management Agency has introduced revenue insurance, where you're not just protecting what your yield is, but you're protecting your revenue. And with the revenue insurance, a farmer could get a payout if either their yields were low or the prices were low, or both the yield and the prices were low. So a revenue insurance payout could be triggered by a fall in prices alone. Now, there's two different types of revenue insurance, and again, it's the same as with the yield insurance. You can have a farm level revenue insurance that's tied to the historical revenue of that farm, and then there's a county level yield insurance, county level revenue insurance, the group risk income protection, where you would get a payout for your farm if the county revenue fell below the county expected revenue. So once the farmer's chosen what type of crop insurance they want, they then have to choose what coverage level they would be covered at. And in general, the coverage level is defined as a percentage of their expected yield. So a typical coverage level could anywhere be between 55% of their APH yield up to 85% of their expected yield, or APH yield. Now, for farmers who want to do crop insurance but don't have established APH yields, there are severe penalties if they have less than 4 years of yield data. So in general, it becomes extremely expensive, or you just don't get a lot of insurance coverage if you don't have that yield data. That's very important for farmers to have. Now, as we mentioned earlier, for those farmers who are going to be very aggressive with pre-harvest pricing, we want to see them at those highest coverage levels for any type of crop insurance that they buy. The last crop insurance decision is what price you're going to be insured at. Now, for most of the crop insurances, the baseline crop insurance is going to be established as the December corn futures price during the month of February. We previously mentioned that crop insurance decision deadline is March 15th. So on March 1st, the farmers learn what that established crop insurance price is, because it is going to be the average of the December corn futures prices during the month of February. So on March 1, they know what that price is, so then they have the information they need to make that decision by March 15th. Now, some of these crop insurance programs also have a harvest revenue option, where farmers can pay an additional bit of premium in order to get the higher of either that February price, that baseline price, or the harvest price. And the harvest price for corn is going to be the December corn futures contract, the average of that during the month of November. This next chart is from the Risk Management Agency of the USDA, which is the group that supplies crop insurance, and this shows what the crop insurance payouts or indemnities were during the 2010 marketing year. Now, we put this chart up just to show you how much money there is in crop insurance and how much variability there is in terms of who gets a payout. You can see that really dark red color is the counties where the crop insurance payouts are over $10 million. The counties in white are ones in which there were zero crop insurance payouts, and so there's a pretty wide spectrum in terms of the amount of money that is paid out county by county, depending on what sort of problems occurred during a given year. The main point behind this slide is just to show you how much potential money there is in crop insurance if farmers have a bad outcome. The last thing to mention related to crop insurance is the last couple of years the Risk Management Agency has introduced what they call the Pilot Biotech Yield Endorsement product. Now, what this is RMA is saying that they have found that biotech crops or crops with biotech traits have lower yield risk, and therefore farmers who plant at least 75% of a crop insurance unit to hybrids with these specific biotech traits would get a lower crop insurance premium. They wouldn't have to pay as much for crop insurance if they're planting these biotech crops. All right, so that is the end of this section on how farmers make marketing decisions, or their timeline of marketing decisions. And we've talked a little bit about how crop insurance might influence their decisions. Especially at this biotech endorsement, you may have some of your seed salesmen being asked questions from farmers about, I need to get these sorts of traits in order to get a discount on my crop insurance.